Petco's Q2 earnings just dropped, and, well, they definitely turned some heads. The big question is this a real comeback for them? Or maybe just some clever strategic grooming?
Right.
So today, we're going to dig into Petco Health and Wellness Company's latest report. We'll unpack the numbers, the strategy shifts, and really focus on what this guidance means going forward. So, okay, let's jump right in, because Petco, that's WOO, on the ticker, they had some pretty big news for Q2 2025.
Yeah.
Significantly beat expectations.
Yeah, quite significantly.
Their earnings per share, the EPS, it came in at 5 cents, which, I mean, that's a 400% surprise over the 1 cent forecast. Just huge.
It really is a massive beat on that front.
And revenue, well, is $1.5 billion. So not just past the $1.49 billion projection. Not quite as dramatic, but still a beat.
Still ahead. And
the market reacted pretty fast. The stock ticked up almost 1%. 0.94% to $3.23 after hours. So that suggests maybe some renewed confidence from investors, especially after some skepticism they faced.
Oh, absolutely. I mean, what's really fascinating here isn't just that they beat, but like you said, the sheer size of that EPS surprise. 400%.
Yeah.
In, let's face it, a pretty flat tech industry right now, getting that kind of earnings pop, even with just a slight revenue beat, it points to something deeper.
Operational purpose.
Exactly. It suggests they're getting much better internally at, turning those sales into actual profit, more efficient, way more than the analysts thought possible.
Okay.
So for investors, yeah, it definitely shifts the mood. Maybe from worry to, well, cautious optimism anyway. It signals management might actually be getting a handle on things.
Right. Cautious optimism. Because, okay, those earnings numbers look great on the surface. But here's where it gets interesting when you look a bit closer. The overall picture for Q2 was maybe a bit more mixed, especially on the top line, the sales figures.
Yeah, that's the other side of the coin.
Net sales actually went down 2.3% compared to last year, landing at that $1.5 billion. And comparable sales, sales from established stores, they were also down 1.4%.
Right.
So for you listening, the immediate question is, wait, how do you sell less stuff but make way more profit? How does that work?
And that is the critical point. If you connect this to the bigger picture, it really signals a very deliberate strategic pivot by Petco.
Okay.
They're calling it strengthening their economic model. So despite those sales dips you mentioned, they boosted their gross margin by 120 basis points. That's 1.2%, reaching 39.3%.
That's a significant jump in margin.
It is. And operating profit, it shot up by $41 million to hit $43 million. Adjusted EBITDA, which is, that key operational profit measure, that jumped $30 million to $114 million.
Wow.
And maybe most importantly, net income swung positive. $14 million profit compared to, a nearly $25 million loss last year?
Let's turn around.
Huge. Plus, over $50 million in free cash flow for the quarter. So what this screams is they're prioritizing profitable sales, not just any sale.
Quality over quantity.
Exactly. The CFO, Sabrina Simmons, she pointed to this, said it was about disciplined promotions and just better execution in the stores. It's a classic retail move, really. If you can't easily grow the top line, you focus like a laser on the bottom line.
Okay, so they're intentionally trading some sales volume for better margins, better profitability.
Yeah.
It sounds like they have a clear plan.
Seems so.
So what does this mean looking ahead? Because management gave some pretty clear forward guidance. That's often what Wall Street really listens for.
It was, yeah.
And they actually raised their full-year adjusted EBITDA outlook, now expecting $385 to $395 million. That's up, 16% at the midpoint?
A very healthy raise. Shows confidence.
Yeah, but they still see net sales declining slightly, low single digits, for the full year 2025. But here's the kicker. They expect positive comparable sales in 2026. So they see growth returning next year.
That's the light at the end of the tunnel they're pointing to.
Right. And for Q3 specifically, adjusted EBITDA expected between $92 and $94 million, up nearly 15% year over year. But again, sales still down low single digits. They called it the toughest sales compare of the year.
Okay, so still some headwinds on sales in the near term, but the profitability outlook is strong and they're signaling growth next year.
Exactly. It's a complex picture, but the message seems to be profitability first, sales recovery coming.
And that guidance, really, that's the core of their optimistic message right now. It does raise an important question, though. What exactly are the strategies driving this confidence?
Right. How are they going to get there?
Well, the CEO, Joel Anderson, he talked about this transformation journey, moving from phase two, which was all about fixing the operating model, getting efficient,
Which sounds like what we just saw in Q2.
precisely, to phase three, which is the return to profitable sales growth. So it's not just tweaking things, it's kind of a fundamental re-engineering of how they do business, how they serve customers, where they put their money. Think of it like a multi-year project, not a quick fix. They're making some, calculated sacrifices now.
Like letting go of those less profitable sales.
Exactly. Pulling back there to build a stronger foundation for the long run. It's a playbook you see other retailers using in mature markets. Sometimes you got to slow down to speed up, but profitably.
Okay, so it's a big shift. Let's get into the specifics then. What are these growth pillars and operational changes they're actually making?
Yeah, the how.
The CEO mentioned 4 key pillars. This is where, the rubber meets the road. 1, amazing store experience. 2, services at scale. 3, merchandise differentiation. 4, winning with omnichannel.
Right. Let's take those one by one.
Okay, amazing store experience. They brought back the old tagline, where the pets go, kind of nostalgic, emotional connection.
It's the branding.
But it's more than that. They're doing in-store events, like free food tastings for pets, even a Feed the Sharks event during Shark Week. And apparently, it's working, getting good customer feedback, higher NPS scores.
Mm-hmm. People showing up.
Yeah, people actually waiting outside for these things,
Wow.
which is kind of interesting, right? In such a digital age, they're really leaning into the physical store.
It's a bet that the hands-on community aspect of pet care grooming, vet visits, events, that stuff can't just be replicated online. It's a potential differentiator.
Makes sense. Okay, second pillar,
Yeah.
services at scale. What's that about?
That's about expanding those high-margin services. Think grooming, training, the vet clinics inside the stores, making them easier to access, more integrated.
Ah.
Because those services don't just make money directly, they drive people into the store again and again, build loyalty, and, while you're there for a grooming appointment.
You grab a bag of food or a toy.
Exactly. It creates this whole ecosystem that online-only guys find hard to match.
Got it. Then number 3 was merchandise differentiation.
Right. This is about making the products themselves more unique. They're redoing displays, giving more space to stuff that sells well, but also bringing in new things.
Like what?
Things like unique pet-themed items for humans, little gifts, accessories, mostly under $20. It's about adding some novelty, some surprise, differentiating from just the basic necessities you can get anywhere online.
Smart. Encourages impulse buys, maybe brings in different shoppers.
Could do, yeah. And it fights the commoditization online.
Okay, and the last pillar, winning with omnichannel.
Yeah.
Which involves e-commerce retooling.
Right. And this is where that intentional pullback comes in again. They basically admitted they were chasing some online sales that weren't really profitable.
The empty calories they mentioned.
Exactly. Heavy discounts, maybe expensive shipping. It boosted the top line number, but hurt the bottom line. So they're not just slowing online sales, they're specifically cutting out the unprofitable ones.
Okay, more focused.
Yeah, think of it like cleaning out the garage, right?
Yeah.
You get rid of the junk so you can actually find the good stuff. They're decluttering their sales. Now the focus online is on the basics. Make the site faster, easier to use, better personalization. They hired a new e-commerce lead, too.
And part of that customer focus, I saw they're relaunching their loyalty program in 2026. More personalized rewards, trying to keep customers coming back.
Yeah, tying it all together, it really does feel like a coherent long-term plan.
It does.
And what stands out to me is just how intentional it all feels. They are deliberately sacrificing some growth now, especially online, to build that more profitable, sustainable base. The heavy focus on the physical store experience, the services, the unique merchandise, it all points to them betting on what makes brick and mortar special in pet care, that personal touch.
Right?
They're chasing the profitable sale, not every sale. And the CFO talking about managing inventory better fits right in. Don't tie up cash in slow-moving stuff. Be disciplined.
Sounds like a solid plan.
Yeah.
Really trying to transform. But, for you listening, it's important we also look at the potential challenges. It's not guaranteed smooth sailing.
Never is.
Investing Pro data, for example, still flags their overall financial health as weak, score of 1.69. Pointing to some concerns still around profitability, cash flow.
Right. Those metrics often lag behind strategy shifts.
Yeah. And their short-term obligations are higher than their liquid assets.
Yeah.
The current ratio is 0.85. That means, less than $1 in ready cash for every dollar of debt due soon. That points to potential liquidity pressures they need to manage carefully.
Definitely something to watch.
Plus, the whole pet industry is, as you said, relatively flat. That makes growth harder for everyone. And they mentioned tariffs becoming potentially more meaningful later this year.
Yeah, external pressures.
And just general macroeconomic worries could still hit consumer spending, even on pets. And we have to remember, getting rid of those empty calorie promotions, while good for margins, did contribute to the sales decline. So it's a balancing act.
It absolutely is.
Yeah.
And that raises, I think, the crucial question here. How do they balance navigating these ongoing financial flags and external headwinds
Right.
while trying to execute this big multi-year transformation? There's real tension between fixing the short-term numbers, like that current ratio, and making these big long-term bets.
It requires discipline.
Huge discipline in capital allocation, in execution. They can't afford for these strategic pullbacks on sales to become permanent slumps. With a flat industry and tariffs looming, they need to be super agile, super precise. It's not just a simple pivot. It's kind of a high-stakes gamble that they can actually pull off this transformation and come out stronger. Especially with intense competition, it'll be fascinating to see if the slowdown leads to sustainable growth down the road.
So for you, our listener, the main takeaway from Petco's Q2 isn't just the headline beat. It's really about this deliberate, complex strategy shift. They're prioritizing profit, execution, the store experience, even if it means accepting lower sales for a while. It's a clear pivot away from growth at all costs towards building something they hope more resilient and profitable.
Well said. And Petco's journey here is, I think, a really compelling case study for any business in a tough market right now, which leaves us with a provocative thought to chew on.
Yeah.
How will this commitment to sustainable, profitable growth, even while sacrificing some immediate sales and facing these headwinds, how will it actually position Petco for, say, the next 60 years of its history, especially in a flat industry with changing consumer habits? What does their story tell us about the fundamental trade-offs companies have to make today between short-term results and long-term survival, and how those choices really shape their future?